The Nuburu stock price, trading under the ticker symbol BURU on the NYSE American, closed its last standard session at exactly 19.11 cents per share on Tuesday, May 19, 2026, ticking up by a modest 0.90%. As we look at the market right now, the current time is 11:57 a.m. Eastern Time on Wednesday, May 20, 2026, and live intraday trading is actively underway. At this very moment, the stock is showing intense intraday volatility, bouncing around the 19 cents level with a heavy volume of microcap orders flying through individual brokerage platforms. The immediate twist that most retail traders completely miss when staring at this sub-dollar stock is that its raw price tells you almost nothing about the actual liquidity dynamics happening behind the scenes. While a 19-cent stock usually signals a dying enterprise on its way to terminal dilution, high-frequency data reveals that certain institutional players like Highbridge Capital Management have recently been adjusting their massive exposure here, including a major 13G filing tracking over 34 million shares. This signals that big money is treating this microcap as a specialized macro volatility instrument rather than a standard long-term investment. The common ground for anyone looking at Nuburu stock is pretty straightforward. Most market observers look at the massive decline from its 52-week high of $4.24 down to its recent low of 15 cents, and they immediately write it off as an uninvestable penny stock. The prevailing sentiment across general investing sites and casual retail message boards is that this is simply an options playground or a target for short-term pump-and-dump mechanics. People look at a market capitalization hovering right around $32 million and assume the narrative is already written. However, if you want to challenge that consensus and take a deeper look, the underlying reality reveals a high-stakes tug-of-war between institutional restructuring and operational survival. When you go beyond the surface of basic self-investing, you see a company whose high-power industrial laser intellectual property is technically elite, but whose capital structure is under immense stress. This isn't just another bankrupt shell, it is a live laboratory experiment in whether a hyper-niche microcap can navigate brutal capital markets while trying to commercialize deep-tech engineering. To understand why this stock moves with such violent daily swings, you have to dissect the recent trading volume and the institutional architecture that dictates its behavior. Over the past month, daily trading volume has routinely cleared 10 million shares, sometimes exploding into hundreds of millions of shares in a single session, such as the massive volume spike we saw in late April. When a stock experiences that level of turnover relative to its tiny float, it is rarely driven by long-term fundamental accumulation. Instead, it is the result of systematic algorithmic trading, retail day traders executing rapid scalps via the Robinhood app, and institutional hedge funds managing structured debt conversions. For retail investors managing their own individual brokerage accounts or utilizing mainstream self-investing options, these volatile microcaps require a completely different set of risk management rules compared to blue-chip giants like Tesla stock, Apple stock, or Nvidia stock. On any given day, a microcap like Nuburu can swing 30% on zero news, purely because an institutional lender decided to liquidate a block of shares or convert a tranche of preferred stock into common equity. Comment below how many shares of Nuburu you currently hold, or if you prefer sticking strictly to megacap tech giants in your portfolio. If you analyze the broader sector momentum, industrial technology and automated manufacturing components have faced significant macroeconomic pressure throughout the first half of 2026. High interest rates have pushed corporate clients to delay major capital expenditures, directly impacting the order books of smaller equipment providers. When large-scale manufacturers tighten their budgets, experimental or premium hardware upgrades are the first items to get cut. This macroeconomic friction cascades down to microcap suppliers, starving them of the early-stage commercial revenue required to reach self-sustaining cash flow. When you look at institutional ownership trends via detailed filings on individual brokerage analysis tools, the presence of major entities like Vanguard alongside specialized credit funds shows that Nuburu is caught between passive index tracking and aggressive distressed asset management. The extreme volatility is structural, built into the very way the stock is financed and traded across modern electronic networks. To truly contrast the market's expectations against operational reality, we have to look closely at what this company actually does and how its core business model operates. Based in Centennia, Colorado, Nuburu is a specialist provider of high-power, high-brightness industrial blue laser technology. The fundamental engineering premise behind their business is that standard infrared lasers are highly inefficient when it comes to processing non-ferrous metals like copper, gold, and aluminum. Because these metals reflect the vast majority of infrared light, traditional laser welding requires massive amounts of power and often results in significant structural defects in the weld. Blue laser light, conversely, is absorbed by copper and similar metals at a rate that is many times higher than infrared. This physical advantage allows for dramatically faster, cleaner, and more precise welds, which is critical for manufacturing high-density electronics, electric vehicle battery packs, and advanced aerospace components. The historical financial reports, however, illustrate the massive gap between this technological promise and actual commercial execution. The company went public via a special purpose acquisition company, a structural route that often leaves early-stage companies exposed to rapid cash redemption pressures. Over the past few fiscal years, revenues have remained incredibly small, often measured in the low millions or hundreds of thousands of dollars per quarter, while net losses and operational cash burn have run significantly higher.
This chronic imbalance has forced management into successive rounds of diluted financing, issuing new shares and warrants to keep the lights on, which explains why the equity price has experienced such a dramatic multi-year decline. Looking ahead at the future outlook for Nuburu stock, the trajectory splits into two highly distinct scenarios, both of which hinge entirely on the friction between investor expectations and raw financial execution. In the bullish scenario, the company successfully secures a massive recurring commercial contract with a major automotive or consumer electronics manufacturer that validates their blue laser technology at scale. If a Tier 1 electric vehicle supplier integrates these laser systems into their standard battery assembly lines, the sudden influx of predictable, high-margin revenue would fundamentally alter the company's valuation metrics. Furthermore, because the current market capitalization is compressed down to the $30 million range, even a modest $10 million contract win could act as a massive catalyst, sparking a rapid short-covering rally and re-attracting retail momentum across popular investing sites. In this scenario, the reality of stabilizing cash flows completely destroys the bearish expectation of terminal insolvency, creating a powerful upward repricing event. The bearish scenario, which remains the baseline expectation for institutional short sellers and conservative analysts, revolves around the persistent risk of capital exhausting. If the company cannot scale its commercial shipments rapidly enough to outrun its operational cash burn, it will remain entirely dependent on highly diluted equity capital markets. For investors executing self-investing strategies, this pattern of continuous share issuance represents a massive structural headwind. Each new round of financing increases the total share count, effectively shrinking the percentage of the company owned by existing retail shareholders and putting a hard technical ceiling on any potential stock recovery. Additionally, operating in the microcap space means the company faces ongoing regulatory challenges, including maintaining the minimum listing requirements for major exchanges, where falling below certain price thresholds can trigger automatic delisting warnings or force management into executing unofficial corporate actions like reverse stock splits. When you synthesize this complete picture, the contrast between expectation and reality becomes distinct. The expectation, driven by simple price charting and negative retail sentiment, is that Nuburu is a declining equity with no structural floor. The reality is far more complex. It is a microcap enterprise possesses high-end proprietary industrial technology that solves a genuine physical bottleneck in advanced manufacturing, but it is currently trapped in a brutal financial framework. For broader context, a retail investor managing a diversified long-term portfolio via standard automated tools or mainstream individual brokerage setups might look at an asset like this as a pure lottery ticket, choosing instead to allocate capital towards stable, dividend-paying assets or large-cap tech. For an active trader, the stock represents a pure liquidity vehicle where success depends entirely on reading institutional volume flow and predicting short-term momentum spikes, rather than betting on multi-year fundamental growth. Ultimately, navigating an investment like Nuburu stock requires an absolute detachment from emotional narratives. You cannot buy into the technological optimism without simultaneously auditing the quarterly cash burn, and you cannot short the stock blindly without acknowledging that its tiny market cap makes it highly vulnerable to sudden, violent short squeezes on any positive corporate development. It is an investment environment defined by extreme asymmetry, where structural market mechanics almost always override the underlying science of the product being sold.
The Nuburu stock world is all on fire right now, and the last trading session was an absolute crunching battle for some serious institutional power players and corporate pick lines. Listen it up because the details get a lot wilder. As the recent Fred Looser ad reveals, the equity prices continued to plummet, shinking even lower from its historically low push report a few months ago. Here's the exact information from the closing station report for July 15, 2026. The stock closed at 18.22 cents per share, representing a short percentage gain of looting 0.73% from the day before. But even at this sub-dollar level, there were heavy intraday fluctuations bouncing back and forth for its serious momentum. If this content resonates with you, or you're considering investing in a complex-like structure like this, please like this video, leave a comment below about your thoughts or investment strategies, and feel free to share this video with others. The Nuburu.com site will also be producing additional fundamental and technical reports doing a deep dive into operational numbers and the current macro dynamics facing the laser industry, including the sudden ultra-high liquidity changes seen, with a deep dive into complex reports made available to all technical and financial researchers from all over the world. To wrap up this episode live, the current time is 1:10 p.m. Eastern Time on Thursday, July 16, 2026, and live intraday trading is actively underway. At this very moment, the stock is showing intense intraday volatility, bouncing around the 18-cent level with a heavy volume of microcap orders flying through individual brokerage platforms. To make sure you don't miss any positive structural and stock technology developments in the upcoming weeks and months, please click on the subscribe button and the bell icon for all future updates and news from Nuburu.com.